The RBA being concerned about investors, as you may have seen in the press. In fact, here's a little article, Your Investment Property magazine from a couple of days ago, the 17th of March. There are, and I've highlighted a couple of things, there are indicators that in the event of a downturn, there may be systemic issues for the banking system, she said, the person from the RBA. It is about whether or not they are adequately provisioned, whether their lending standards are adequate, and if there is an oversupply and falling prices, remember oversupply and falling prices, whether they end up underwater or wearing larger losses than they expected because they hadn't anticipated this. Bullock expressed strong concern about households that purchase apartments in high-risk cities with the expectation that rents and prices would rise. There's a strong possibility that such investors would fail to find tenants due to the incoming glut of apartments, she said. The Australian Prudential Regulation Authority, or APRA, instructed banks to tighten lending standards for investors 3 years ago. APRA has since succeeded in keeping investor lending growth below the 10% cap. However, quote, everyone should be aware that more recently investing housing growth has started to speed up again, said Bullock. We are watching it because investors can be the first ones to get out if things turn, Bullock said. She warned that a rush for the doors when the market started to show signs of stress could make a slump much bigger than it would otherwise be. We don't want households to find themselves in a situation where they have to emergency sell or whatever because they can't afford the investment anymore. So this all just backs up the sort of theory that I've given you earlier on. And if you remember the newsletter that I wrote for PropertyInvesting.com a while back, the importance of understanding the percentage of people who rent versus own outright versus have a mortgage in your area, because if you're in an area where there is a higher percentage of renters, it must mean that there's a higher percentage of investors. Any area with a higher percentage of investors is a riskier area as interest rates start to go up. Because if investors decide to sell en masse, then you'll see a situation like what happened in Moranbah and Port Hedland and Gladstone, where prices can drop and drop quickly. And one of the assumptions in real estate is that there'll be someone who wants to buy your property when you want to sell at a price that you're happy to take. Maybe one of those two assumptions, i.e. there's someone who wants to buy it, and the second one at a price you'll take, are wrong. Maybe you can't get the price you want, get the price you get if you get a price at all. And there's nothing worse than being a desperate seller in a market where there are no buyers. It's a horrible experience, and it's almost better that you never invested in the first place than find yourself as a forced seller in a down market. So these are the tentative wobbles, we'll call them. We won't call them warning signs just yet. We'll call them the wobbles that are happening in the background that cause us to think, well, maybe, yeah, interest rates probably have bottomed and they're probably going to go up. So everything else being equal, mortgage stress pretty tight, people have borrowed a lot of money. Do I really want to be balls on the barbecue, to be a little bit crass, with my investing, given that the general inherent risk of the market has probably gone from DEFCON 5 to DEFCON 4, i.e. it's probably a riskier time to be investing now than it was a couple of years ago when interest rates were pressure on them coming down. And we've also got markets at very high levels. We've got a glut of supply coming on. So with all these kind of, I guess, slightly heightened warning signs, I just think you've got to be a little bit more cautious. Cautious. I think that's a combination of careful and cautious. Cautious. There you go. There's a Steve word for tonight. You've got to be a little bit more cautious with your investing than you might otherwise have been. Of course, that doesn't mean you need to put the cue back in the rack and forget about it altogether. It just means you need to be careful. You need to be diligent. You need to be kind of mindful of what's going on around you, which of course is common sense. But unfortunately, greed gets in the way of common sense, and people start making decisions thinking that the conditions that we've got today are always going to be with us. Of course, they're not necessarily going to be. So I call them crash factors. What are the sorts of things that may occur to mean that prices are going to suddenly drop? First of all, the theory is that there has to be a sudden increase in supply well above what demand can absorb. So can you think of a situation where all of a sudden people are like, almost overnight, holy crap, I've got to sell, I've got to put my market up for sale. What do you reckon? What's a situation where that might happen? Can anyone think of one? Looking at the screen, sudden, there you go, job loss, Pete, well done. So if people lose their jobs en masse and there are massive shutdowns. Now, the biggest employer is, of course, the government. So if the government overnight has to shed thousands of jobs for some reason or another, then that's going to be catastrophic. We see a bit of a transition going on in Melbourne, South Australia at the moment, or Victoria and South Australia, as car jobs are shed, as the manufacturing industry closes down and people are figuring out what to do with themselves or what they will do with themselves when they don't have a job anymore. That's another example of an industry closing down. You have to think about construction. There are a lot of people employed in construction. If they stop building apartments because there's a glut, what do people go and do if they can't get a job building something? I mean, it's been very convenient. I know there's downside to this glut of apartments, but it's been very convenient to have this apartment boom, this real estate construction boom go on at the end of the mining boom, because it's allowed people who were in mining to transition into construction. But if those construction jobs dry up and the mining jobs aren't back because the mines have been built, I mean, you can only kick the can down the road so far before it can't get kicked anymore and it's reality day. Now, I'm not being Mr. Doom and Gloom, don't get me wrong. I'm just saying things are changing and we ought not to stick our heads in the sand. We just need to be aware of these changes and just stress test our investing to make sure that we can cope with one or two downside events that won't wipe us out. Don't want to be swimming at the beach when the tidal wave comes in, do we? So another instance is what I call a valuation risk. And we're seeing this a bit with the apartments. So you buy an apartment for $500,000 off the plan, comes time to settle. You want to get an 80% loan. You think you're going to be borrowing $400,000. You've got $100,000 squirreled away plus closing costs. The problem is the valuer comes in and says, no, this I know you paid $500, but there's a lot of apartments coming on the market. This is only worth $400. So now the bank will only give you 80% of 400, which is 320. You were expecting 400,000, so you've got to now come up with 100,000 plus another 80,000 plus closing costs. What happens if you can't get that extra 80,000? You can't afford to settle. If you can't afford to settle, then the developer needs you to close so that they can grab the money and pay off their debt. Then if you start defaulting, then that becomes a self-fulfilling prophecy because valuers see that the defaults are kicking in and properties are reverting back to the developer. The developer can't sell them again for the price you paid for them. So this mushroom kind of falls on itself. And that's what the RBA is worried about, the beginning of the end, all right? If you start getting properties that can't sell and have to sell for cents in the dollar, that undermines the valuations. It means people that haven't settled yet won't be able to settle necessarily at a price they bought for. And then there's contagion into the housing market. And psychology is a bigger driver than fundamentals. So people start getting worried about real estate. Oh my God, the end of the world's coming. People stop buying, but people have to sell because they're being squeezed because interest rates are going up. And then all of a sudden the great deals are out there, but no one can qualify for a loan because the banking industry is in turmoil and they're not willing to lend with the same lending standards as they had. It's exactly what happened in the United States of America. And so people are out there trying to buy these great deals, but they don't have cash and they've got their own investments that have turned a bit sour. And so those people who are poised to take advantage of a downturn are those that have lots of cash, lots of borrowing ability, strong balance sheets, strong credit histories, and not the people who are out there trying to bag a bargain from the bank. They're hard to find unless you're an all-cash buyer. Interest rate spike. If interest rates all of a sudden go up 2% in the course of a few months, that's going to put the scary cat in amongst the property pigeons, isn't it? And there might be a few feathers that start going flying. Unemployment spike, like Pete said, or as I mentioned before, this psychology spook. If people just get spooked all of a sudden, the headlines in the papers start saying the end of the world, etc. What are we going to do about it? And as more and more people think the glass is half empty, even if the glass is half full, it becomes half empty, because as people think, so they act. And as they act, so they do. And as they do, so everything happens.